Welcome to the Twomey Stock Market Report. Today is Sunday, February 26, 2023. And we're going to go over the weekly market report from the Twomey Stock Market. I want to go over some key items that will help you out in your trading, especially the events that we are foreseeing the next 2 weeks. So, very important time, and we've gone through quite a bit. Last week was not necessarily a shocker, but it has turned the tables on our. We were somewhat bullish sentiment with prognosis of fairly up until, slowly up until the end of the first quarter, and then probably a sideways market. That is abating. We're now more neutral to bearish, and we're going to talk in depth about that today. First, I want to kind of go over a couple of things here as I get through. We're going to start at the bottom here. We're going to talk about and then work our way up in the report here. But you can go right to the website at TwoMeyStocks.com, and you can get all this information right there at the website. It's online. You go to the number 2 mestocks.com, pull down the weekly newsletter right here. You could also get our videos. You can view those online, and those are absolutely free. And you have the option to sign up to see our trades live, as well as receive our alerts via electronic email, and you get all the alerts coming your way. But let's get right into the depth of it. And, we're going to go over some charts. We're going to go over some of our tracking. But first, I want to give you a little bit of I always call it the eyeball test. Did some traveling around. We went out to Boise, Idaho a few weeks ago. Certainly that area out there, and of course, it's not the building season, right? But it is for ski season. It seemed fairly slow. There was some activity, but fairly slow. And certainly the building has abated quite a bit. There is some good deals starting to surface if they were people buying a year ago there. And in addition to that, the traffic didn't really increase. Didn't see a lot of retail changes. So that kind of tells us that area that was red hot is slowing down. We went off to Nashville shortly after that. That's a great place for young folks. It really attracts a lot of young adults. Downtown got revamped a little bit. There was a lot that was put in for the pretty much, new eateries and shops and what have you. And, several floors are really attractive for people that have children, or if you will, that don't want to go to the bars necessarily, but still enjoy the environment there. Very nice. Didn't see as much building. Building season there goes year round. The traffic, pretty much the same as it's always been. It had elevated several years ago, but I didn't see more than normal. And then in addition to that, I know that they've done a lot of work at the airport there, and the airport has really handled the crowds, especially the holiday weekend. And it was, very busy, but they've got plenty of people handling the workflow, whether it's shops, restaurants, the airport. Didn't seem to be a labor shortage there. But I sensed that less expansion and more sustain is really where they are at. Then we went off to the west coast of Florida, Clearwater, all the way down to Fort Myers. That was a totally different story. It was a shock. I hadn't been there in a little while, but overall, it was jam-packed, building infrastructure, building homes. There were just squares of land, cookie cutter homes side by side by side, all dimensions and sizes. And in addition to that, you couldn't move on the road. I know it's snowbird season. Granted, there's more travelers there, or renters, or the winter snowbirds go there and they come back in the summer, but that own property there. But everything was these 3-lane or 2-lane major roads, intersections, light after light. You missed your turn, you had to go back and around, and it took 20 minutes just to go a couple of miles. It was unbelievable. In addition to that, the highway was just as packed, so that wasn't a shortcut. And then there was, tractor trailers, there was construction vehicles, there was all types of working vehicles type everywhere, from vans to trucks to pickups to hauling goods and gear. Very, very busy. That place is on fire. I don't see that slowing down anytime soon. Any realtor that you came across, it was pretty much, if you were just poking around, they had no time for you. They're only going to spend time with people who are ready to buy. And they said there was a lot of cash coming in. In other words, people selling their homes and moving in there with cash. So Florida hasn't changed. Okay, let's get to our numbers that we track that are going to give us a little bit of insight on what's happening in the market. CBOE, what is this, the put to call ratio? I look at that. I don't look at it on a daily basis, but week to week to kind of see where that trend is going. Is there more short sellers or not? In the last 5 to 6 weeks, it was all bullish. There was no real indication that short sellers were coming back into the market. We had flushed them out on this immediate up track, and we'll show you that in a few graphs. But now it's climbed up into bearish territory at 0.82, and we suspect that's going to stay elevated for some time. And I'm going to go quick chart here. This is the S&P on the daily. What happened here? From October, the diamonds. What happened here? Really, October, end of mid-October, all the way up into December. This, the SPY is a little bit different story, but we had a big run up, and we're going to go over this in a little more detail. But as we come back down and get off this sideways trading zone, we start hitting these numbers here at on the diamonds at really, quite frankly, it closed at 318. You get around 318, 320. I mean, you're almost hitting into that sideways move, right? So you got to close. It closed at 331, and you get into the 324 all the way down to this 298. There was a rapid buy up. There's not a lot of short-term support. So we break through this support level, we should easily get down to test the lows of December. But we'll see. It's too early to tell. But overall, what we're seeing is potential change. More shorting and more selling. That's what that tells us. We go into the advanced decline. Advanced decline of the New York Stock Exchange is a large breadth of stocks. It gives a much more global picture. I shouldn't say global, a bigger picture, because there's a plethora of stocks in there, all different sizes and dimensions. And you've got more, as you can tell, since the peak, we've got more declines and advances. It's coming up against the 50 EMA, and then the 200 is shadowing right underneath that. Last time we poked around the 50 EMA after having a run up, it came right back down to the lows after the August bear market rallies. Then going up, we had a harder time, but we kind of hugged the 50 back up and down, little test below, and then we raced off. So you can tell it comes down faster than it goes up. So if it breaks through that 50 in the next couple of weeks, it'll break through the 200, and again, we'll start racing towards the December lows. I'm not in the prediction market, but that's what it's starting to look like. In addition to that, only 60% of the stocks are now trading above their 200 EMA. The height up here when we get the peak was around 71. So, it takes a lot of breadth of the market to drop 10%. That means, it says, 10% of the stocks. Yes, but that's a big number. 10% of 1,000 is different than 10,000, 10% of 100, but it's still, and it's still 10%. But when you're talking about big numbers, you got to pay attention to the fact that many are dropping. We're seeing the RSI down to 46 range, which is pretty good. We alleviated the oversold, but it is not slowing down, and it seems to be heading south. In addition to that, you couple that with the MACD, the momentum indicator, the fast close below the slow, and as the gap widened be the fast and the slow, we're heading quickly to zero level or negative, and that looks like it takes a lot of time to get that into positive territory. If we don't want to break that zero level. If it does, then we're heading even further south. So that's telling us selling is on the horizon, as well as we obviously experienced quite a bit last week. And then we look at the RSI, Relative Strength Index, of our favorite indices. Well, the SPY, 42.25, it was up around 56, was 63 3 weeks ago. That came down quite a bit from its overbought, and now we've seen rapid selling once it broke the 50. The diamonds, which is our proxy for the Dow Jones, had been more neutral the past 6 weeks, right? 47, 54, 62, but then it leveled out the low 50s, and all of a sudden we're down at 36 and a half. That's near oversold territory. So the Dow took a real hit, which was surprising because you would think that would withstand the pain more of those bigger stocks. But once Home Depot, Walmart, these numbers came out on retail, the consumer is strapped. These retail stores are struggling. The big box stores are struggling. It's a real, the market doesn't like when they see those type of prognostication by those type of stores and where they're headed. So that was bad news. NASDAQ's 46, Russell's 47. Those are not quite, we've got sell signals in everything in the indices, the SPY, the Dow, the NASDAQ, as well as the Russell. There's more room for the Russell and the NASDAQ to fall and pull back. On the short side, we've got buy signals on the short for the SPY, which is SH, and DOG, which is short for the diamonds. We got buy signals there, and then they're up in, the DOG, like I said, 65 near overbought territory for the short side. So rapid movement, but it looks like the NASDAQ and the Russell, those would be places, and I'm going to go into a little more detail later, but that'd be the places to start looking to short. Not right yet. If you do, it'd be a very short-term trade. So that's the relative strength is telling us the market's weakening, no doubt. But it's rapid, which is the telltales. Instead of that sideways market we expected, we got a rapid decline. Will it hold? It didn't hold the 200 and the 50 on some of these, and that's the disturbing part. We look at our sector table. Where's the money flowing? I sort this for a 1 month trend. I tend to look more picture like 6 to 1 year, 6 month to 1 year to get a more, long-term view. And, really on that, the long-term 6 month is financials, industrials, and then we certainly have materials here. But the big one, energy, which was our big winner last year, it's 2.57% for the 6 months. So energy is really fallen out of favor. Right. And if you look at a 1 month trend, everything's in the red. No surprise there. What I look there, though, is I look at the utilities and healthcare, consumer discretionary, which is kind of our defensive sectors there for the 1 month. They're still pretty deep red. Right. So we haven't had that shift of move to the defensive sector just yet. If it starts to show up this week, there may be some good early buys on that. We'll alert subscribers, but I think what's going to happen is we've got a couple of things happening. Might as well just go over to here. I mean, we've got 401k money coming into the market Wednesday and Thursday, so that's new money. Fund managers have to put that to work due to regulations. So we would expect maybe some early selling in the week and repositioning by mutual fund buyers, and then to kind of shore up their books. And then as that new money come in, they go put it to work. My guess is, my theory is, versus guess, that employment is still high. There's a lot of people working. Those folks who, especially long-term, look at their 401k, say, yeah, it was down 20, 30, 40% last year in certain areas, but I'm dollar cost averaging. I'm buying low as I bought high, and it all smooths out. And as the market comes up, that dollar cost averaging helps them. So they're going to continue buying. And they're probably not going to reshape their portfolio, especially after this recent run-up. And they're feeling like, the bloodbath is over. So I think that money's going to come in. It's going to cause some buoyancy in the market, drive some numbers up. That will scare the sellers of the past week or two. It will scale the shorts, and then with the telltale will be the following week. And if that does not hold, if we start seeing some rapid selling, and we'll know early that following week, I would say that's going to give you the idea of the trend in the next few weeks and to a month and a half. So we're on the watch for that. After the 401k buying, it might be a good time to add to your shorts. We continue with our shorting of the 20-year Treasury bond ETF. We use TBT. We use the 200% version. This typically doesn't move that fast, but if it goes up $1, it goes up 2 for us. If it goes down $1, it goes down 2 for us. But we're up 8.2% after our early entry before the buy signal on February 8th. We're maintaining to hold that. We looked at it as that is more of a quick trade. Right now, that's expanding. The Fed came out and said we're going to raise yields. Now the talk is to go 0.25. No, maybe 0.5 in March. Inflation, the Fed's now really worried. It's not going away. They feel it's going to be higher. They can't, the PPI came out. It was 0.7 versus 0.4. I mean, this is all negative news. We're in the yields. We're going to maintain that. And I would say if any time that gets into this is a small graph here. Let's go to the full-size graph here, TBT, daily chart. We use Street Smart Edge here. I'm sure there's plenty of other trading vehicles. This is the daily chart. We haven't eclipsed that recent high. And, right now RSI here is 61. So there's still room for this to run. The MACD is healthy. The stochastic staying well up. Anytime this gets down around the 9 EMA and maybe, if got to the 14, but around the 9, you can safely add for a little while until we get up to the next high. We may be in this zigzag trading zone for a while. Not sure about that, but right now our premise has changed that we might be able to hold on to this a lot longer. We've changed our stops. We did send those alerts out this weekend, and adjust your portfolio accordingly. Let's see what's next. So that's strong. We go over. We have the environmental analysis. What's that says? How is the worldwide economics, taxation, government spending, non-spending. So there's some detail in there that kind of helps you a little bit. We do track energy as well, and I want you to get familiar with that because those are kind of more the bigger outside forces that are going to affect companies borrowing and trading and selling, etc. I think our number one concern really now is employment, right? If employment stays, we can weather the storm, but inflation is running up that where companies have gotten to the point they can't pass along our cost anymore. And if they do, it just really affects the consumer. So I think consumer sentiment is going to wane even further. And that PPI number, I don't know. I mean, it could be just a lag factor because a lot of data comes in December. People on vacation, it's holiday time. From businesses to governments to you name it, data gets kind of sloshed around, doesn't necessarily get all the full information. So you kind of have to wring that out over a couple of months of the new year. But we're not coming all this data that's coming out. You have to treat it as suspect. Nothing's been accurate the past 6-8 months to a year. Everything's up, it's down, there's revisions. So you got to be cautious. But the traders are reacting to it, especially if it's negative numbers. All right. What do we got? We looked at the Dow daily chart. That's what we talked about here. And let's just go to our chart again here. It's a little bit bigger. I'm going to, we talked about how it's gone sideways pretty much, right? Now we've got a little bit of that sideways. It's a little bit of a negative bent. And I'm going to expand this. What we did was we broke the 50 EMA. We originally thought that would be a nice area because it's been bouncing off that. It cascaded well below that on the news. Hit the 200. We said, hey, that should be able to rebound. It did briefly, and then it just jumped way down from there. So we're in a point where we broke all our long-term technical support levels, and that in the diamonds, which is really the Dow Jones, which is a pretty safe haven, and a lot of folks keep money there. So that's telling us, we're in trouble. And then if that continues and we break even further, we could test the lows of December, and that would not be good. Let's see. What else do we have in our tracker here? We also, we talk about the SPY. On the SPY, a couple of things. This is a little bit different chart. We were saying since the Dow was going sideways, right? Would the SPY also go once buying exhausted? Would it go sideways? And that just like the Dow for a month and a half, 2 months, and then kind of might get one more push for the end of the quarter, and allowing us to hold our positions, right? The stock market goes up and goes down. You want to hold your positions. You want to get some core positions. Well, this week we we hit through our short-term indicators. So we got a lot of first and thirds of our stops on our first third positions got stopped out for nice gains. And then in some cases, on Friday, we did send out some alerts to just get out of everything in these particular certain higher risk stocks. There's no sense holding on to things that are going to go back. If they jump up, we can get back in. You might miss a couple of percent, but you know how it cascades. It cascades down 2, 3, 4, 5% in some days, and you can't get out fast enough, right? So let's protect profits and capital. But it broke through our short term. We got a sell signal, just like in the Dow and the small caps and the Nasdaq. After the sell signal, we hit the 200. We blew past the 200 and the 50 are about equal weight right now. We're blowing past both those, and we're below that. Will we get a bounce from here? Potentially. Hard to say. The MACD is the fast momentum indicators. Earlier last week, broke below the slow. That's telling us a change of direction. It's a longer trend that we look at, and then all of a sudden, it's the fast oscillator. Fast momentum is down 0.57. If it goes below zero, we're in for additional selling. But that's a steep drop off, very quick drop off. It takes a lot of momentum to move the MACD in a short period of time. That's of a concern. We look at the stochastics. You can see how that went sideways. The fast oscillator, and this is our quick trend. You see something that goes below 50, 75, and then to 50. We say, hey, there's definitely a short-term trend. There's going to be selling. Be prepared, and that's what we warned our subscribers last week on. And sure enough, broke through. Now we're down at the bottom at 11.9. There may see some bounce, but it can stay down here, as we saw here, from December all the way into January for quite some time. So we definitely are. It's rearview mirror stuff went after the effect. But once we saw that during the week, we tightened our stops and we took advantage of some of those stops and booked some profits. So that's what we hear at the Twomey Stock Market Report. We tried. Yes, we're a trading vehicle. We'd love to be long-term investors. That's the way we all want to be. But in this case, we have to be careful. And we set up our trading and use our technical indicators to give us, so our trend bias was to kind of be long and then hold through this for a sideways movement and have nice core positions maybe well into the mid part of the year. Now that's shifted, and the reason why it has is because our technical indicators are telling us something else, and therefore we want to make sure our bias based on our fundamental analysis doesn't get skewed, right? So that's what we did there. We look at the overall trend. This is the bigger picture. If you look at the Nasdaq, we have this upper trend, Twomey trend track line. The prices came up. They keep repelling. We're down below that. We're breaking our recent uptrend, and that looks like there's going to be further selling ahead as well. The pressure is on. There's no doubt that the pressure is on. And the sentiment is that the markets are treating from this latest run-up. We have the Twomey sell signals for the diamonds, the SPY, the Nasdaq, and small caps. On the short sides, both the SPY and the Dow have buy signals. We didn't jump into that. We're a little, and the reason why is that, and yields are continuing to rise. We're along that. The reason is this: the 401k money coming in with all the high employment. I believe that's going to shift the markets. I really do. If it doesn't, the markets continue down. It is what it is. We've protected our profits anyways to fight another day. We also have made some moves in our mutual funds, which were a little earlier than we expected. So we alerted subscribers on that, and we also sent out alerts for fixed income. Let's face it. This is what the pressure of the market that we're seeing. If the market is not going to stay buoyant, and you can get 5% on annual return on CDs and treasuries and munis with the tax beneficial, why put your money at risk? You take a big chunk of your portfolio, you put it into a 5% and for the year, or like in my case, we recommend a 6-month version of that, so you get half of that. Right, the first 6 months. If the yields go up further, you roll it over. Instead of coming out with 4.9 CD, the one we recommended, you might come out with a 5.2 year over year if we stay with it. Money markets, 4.79, Schwab's 7-day annual yield for their money market fund. It's very liquid. will it stay there all year? Hey, it's been up in 4.5, 4.3% for quite some time. We've been over four for a while. So and you can move your money around. So people are not going to take the risk. They're not going to take a risk. And, one of our positions, I want to go in this. We can go through our trade tracker real fast, but one of our positions is. Let's see if I can find it here, is Annaly, which is, capital management is a place where we tend to get high dividends, 16.85 right now. It's dropped down. We're down 5.5% on NLY. But, we look at that as they say, it does move. You got to be careful. We can't hold that forever. But, we said if we get this sideways market and we can kind of drift through the next 6 months and pull up that first, 5, 6, 7, 8%, that's great. If we hold it in the rest of the year and end up with, anywhere from 11 to 16, terrific. But if it drops, that's what you got to be concerned about. And it can drop. So we have to be on the watchful eye because we're down already 5%. Not bad if you can collect 15 or 16 and you end up down 5% from the entry price on the NAV, you still end up with 10%. But if it drops another 5%, you're only in net 5%, maybe 6%, with a little bit of worry, hey, you would go into a CD or a treasury and get that 5% guaranteed, and it's protected by, FDIC. Whoa, this is the sentiment I'm trying to explain. That's how investors are looking at this. I'm not saying long-term investors. Short-term traders, these day traders or trend traders, which we do a lot of. We do a lot of trend trading. But I'm looking at people who kind of say, hey, I'm getting near retirement age, or I'm in retirement age, or, I've got to park some. It's cash is working. It's working now. You can get some money and still, are you going to beat the S&P? I don't know. That's always the dodge, right? But if we look at year to date, what are we year to date here? I think the Dow Jones -1, S&P 3.4, right? NASDAQ 8.9, Russell 7.3. Well, that's year to date from January 2023. Well, if that flattens out, if you had all your money in kind of Dow Jones and SPY stocks, maybe a little bit in high tech, right? You're probably netting around 3%, maybe less. The first, quarter, you would have got, and if you could have been in safer haven, right? And gotten this, less than that, but you're poised for not losing money, right? So that's what people are doing. They're heading in that. A couple of things that really were nervous. The Fed Meister, she came out, Mueller, he came out. These are the Fed presidents, one's in Philly, one's somewhere else, but they came out and they said, we really pushed for more than 0.25 last rate hike. March rate hike, we really like to see 0.5 after this PPI number that came out. Boom. That really was the shockwave. You had Home Depot and I think Walmart, whatever, these really were negative numbers. Not necessarily on revenue, but it's like year over year and projection of sales and where, what was being, Home Depot said they were really focused more on the service side versus the do-it-yourself come in and buy goods. Really strange. They said they got hit by the lower cost of lumber. That doesn't make any sense because if lumber's less, they would sell, more people would buy it. But I guess if they bought in bulk at high numbers and had to come down on their prices of what that was already bought, they lost that money there. Maybe that's more to the picture because they're big box stores, right? Anyways, with that said, you've got that, draft in the economy, the draft in the consumer, all are kind of, waning as far as having strength. Credit cards are going up. The lower income folks are getting really shellacked. There's more and more information coming out that they're not meeting their utility bills, that they're behind on some rents, they're behind on some car payments. Not good. They can't keep up. And, there's more and more, if do the eyeball test, go to the grocery store, look at the size of the carriages. Are they big as they were before? Go to some of these discount, whether it's TJ Maxx or something, and take a look there, see what they're selling, see if there's more stuff on the racks. The pricing hasn't come down yet on the food and some of these, discount stores. It hasn't come down, but I suspect it will. And then I think you'll see that will help. Another couple of things happened. The COVID relief is going away in March. The low-income families were getting food subsidies, $95 a month or more, and that's going away. That's a big impact for those folks, and that is a drag on the economy. More and more people I talk to out there, and I'm always asking because I look for cracks in the cement, or the walls being built up for bigger support or better foundations. And I talk to I'll say, hey, you're getting the hours at work. It must be shorthanded, and they're saying, well, we're not as shorthanded as we were before. We do have staff, but how about yourself? Is that hurting your hours? They said, well, it's okay because I have a second job now. So a lot of retirees are coming back into work after the ones that retired during COVID. They're finding out they want more flexibility. They're taking lower wage income jobs. That's why those sectors are getting filled up. But they have to go back to work versus relying on their stock portfolio or their investments. I talked to a friend of mine who recently retired, well on in age, early 70s. So worked pretty hard up until the end. And ended up going with some type of an annuity just because he didn't want the aggravation. It was get 4% guaranteed, and if the market goes up over an X number, they get 8 point something percent. I'm not recommending annuities. You got to look into those. There are some good and bad. Some of them you can't pass the money along after you pass away. I mean, there's a lot of pitfalls in that. I've certainly, in industry, I worked out a couple of insurance companies that went bankrupt that, those annuities, unless they're backed by something else, they get, you don't want to go belly up on those. But be careful. Talk to an expert. They'll tell you. And I believe that's what we're going to run into here at the stock market report. That's what we're looking at. All right, so let's go real fast. 8.3% on our 8.2% on our TBT. Add to that if it gets down around the 9 or 14 EMA. We get out of our small caps. We got 4%, about a 0% and a 0.5%. So at least that we got a little bump on that. The high tech we got out maybe a little early, but not a bad trade since January 13th. We've got averaged about 6.5–7% there. Not bad. We'll take that every day for a month and a half. We got MGM Resorts is still running strong. We're at 12.4%, but we changed our stops. We're not going to fool around. We're going to hold on to that profit. We can always get back in. Annaly Capital, we already talked about. We've got to be careful on that because we don't want to lose our premium. And then in addition to that, the XLI, we did get fully out of that. We never really made much of a gain there, but did preserve capital and would have liked to have held that, and I believe it could still rebound. I think that sector with the infrastructure play has still got a lot to go. I don't know where all that money is going in the infrastructure. I don't know. We still see catastrophic events happening around USA. I mean, that money's got to be going to work eventually, but we'll see. All right, Borg Warner, we're still holding that. Change the stops on that. We're at 18%, and then that's part of that consumer discretionary industrial play. And then we also had the Plains America Pipeline. It's holding well at 10%. Add to that if you get under 12, right? And that is, I believe that's got 8.05% dividend right now. All right, JP Morgan, that's another dividend play of 11.9. That's kind of pulling back. We got an active buy on that as well. We got out of Advanced Micro. That was one of our high-tech plays. We got in there January 25th. We ended up with 7%, 8%, and 11.3%, a third. So we netted about 9% for that trade. We'll take that every month and a half. Not bad. Enterprise, we're still in. Again, that's a dividend play, 7.6. That's holding at 2.5. So we're kind of going into a different energy sector play. We're not taking the risk of the natural gas, the oil play, or even XLE. We're going to go into this delivery high dividend, and we're going to see if we can maintain that as prices hopefully stabilize there. Mutual funds, we sold half of our positions, and we're still in the green on most of those except for the PRBLX, which is the Parsons Core Equity. That has a high dividend yield for high dividend type stocks, but we still sold half of that. So that was a disappointment. But we're going to hold half for now and see where that takes us. And, we did recommend, we're using Charles Schwab Bank of Texas, 4.9% annual CD rate. We took the 6-month version, which is 2.45% for 6 months. Can certainly roll that over. Great place to park money. And if you can, if we want to roll it over as we anticipate rates to increase, that may be, 2.6% for the second 6-month version of that. So we're going to take a look at that. Money market, we're in that Schwab's money market. That's 4.79%, 7-day annual yield. That fluctuates, but it is, you can get your money right away. And of course, we still recommend I-Series bond. We're trying to get this core established, these mutual fund core established, see if, withstand some of the trading negativity that we expected, but it's happened a lot faster than we liked. If you look at the XLK, which is our tech sector version of NASDAQ, we were hoping that 50 would cross above the 200 and start giving us that push for buyers, and instead we've got a downward draft. We've got a lot of negative selling. We've got 4, 5, 6, 7 days of all high selling volume. Will the 50 and the 200 hold serve? It did not in the Dow. It did not in the S&P. IWM is our proxy for Russell 2000. Small caps, same deal. The 50 did cross above. We did get the golden cross. It hasn't really proven out to be anything that positive, but it does tell you there's more buyers than sellers, right? And there's less short sellers. But we're in a little bit of this one is coming down. It did cross below the 50, right closed at it, and now we're heading up against the 200. The volume, we had some nice up volume on Friday. We had some nice up volume, but it didn't break through the last previous low. So there's definitely high volume trading here. We're going to have to see where this brings us. This could, after the 401 money comes in, this could be a good place to, this and the short side of the XLK could be a good chance to run some shorts, and we'll make those decisions and alert our subscribers when that occurs. For now, we've taken some profits off the table. We've preserved some capital. Go to the number 2, mestocks.com. Pull this whole weekly newsletter. You can check out the fundamental analysis and compare that to the technical analysis. See how that works with your trading philosophy. And you also can listen to our real-time video, right? And then if you want to sign up for receive our trade alerts and our daily video updates and our training vehicles, absolutely. Jump into that. We'd be happy to have you and send that information to you real time. I'm James Twomey, and welcome to the Twomey Stock Market Report and the Weekly Report. Have a great week. Thank you.